Hi students, this is the Chapter 1 Financial Accounting PowerPoint video to be used with your Chapter 1 notes in your Word document. Follow along and fill in your notes. You can print it off or you can follow along in Word and type in your notes as we go. Alright, number 1, the difference between financial and managerial accounting. When we talk about accounting, we often break it into two organizational groups. We say we want to report data to internal customers or external customers. Managerial accounting is concerned with the information that is reported to internal customers. It's concerned with providing information to managers for use within the organization. This information is privy to the inside, right? So inside managers and inside employees. This is pertinent to making decisions within the organization, such as what should we sell, how much should we sell it for, how many customers should we go after, are we staying within budget? So all this information is used for planning, controlling, decision making. It's the information you don't want your competitor to know. Now in managerial accounting, there's no oversight and compliance. There's some basic fundamentals that you can follow, but different organizations will treat their accounting differently. So say you have two different car manufacturers. Those two different car manufacturers are going to be doing their managerial accounting probably a little bit differently. There's no mandatory oversight and compliance on the rules you follow as a managerial accountant. Now financial accounting on the other hand. Financial accounting is concerned with reporting financial information to external parties. Information that outside organizations would be interested in, such as creditors, investors, directors, the government. These outside organizations are going to use that information to make their own decisions. It's the basic health report of a business. So you go to the doctor, you get your blood work done. It says a lot about you. Well, the blood work for an organization is their financial accounting reports. It says a lot about the organization to another person outside the organization. Because so many external stakeholders rely on this information, there are rules financial accountants follow set forth by the government. We call these generally accepted accounting principles. We'll get to that at the end of this chapter. What we'll look at in this chapter is an introduction to some of those rules and the external reports that are required of public companies. Alright, the basic accounting equation. Assets equal liabilities plus owner's equity. There's a good chance you've never heard of any of these things before, and that's okay. This is going to become the foundation for everything we talk about in this class. It's the basic accounting equation. Nearly all financial accounting concepts will grow from this basic equation, so you need to learn it, memorize it, tattoo it on your arm, whatever you need to do. It is extremely important. So let's break it down. What are assets? Assets are any resource controlled by the business that has value or is measurable. It can be thought of as what the company owns. It applies to every type of business which we're going to explore. So when we talk about assets, we might say things such as cash, receivables, supplies, inventory, equipment. It is a resource to the company. It's measurable. Again, think of it as kind of what the company owns, what they have in their possession. When you go down to McDonald's and you get a burger, you look around, you see the building, you see cooking equipment, you see food inventory, you might see supplies, there's a cash register. These are all assets to the organization. The McDonald's that you're in has use of those resources. Now those resources are going to be broken down into who actually owns them, whether it's the actual owner or somebody external, a liability to the organization, so maybe an investor or a creditor. Those investors or creditors are going to be your liabilities. It's kind of a difficult thing for students to grasp, but basically think of it like this. The car you drive, you might own actually half of it, and the bank might own half of it. You're still paying off your loan. The half that the bank owns, that's a liability. The asset's the car, but the liability, half of it might be the bank and half of it might be yours. Let's go back to the McDonald's example. The McDonald's store down the street has a building and all of the other assets we mentioned before. Might owe some money to the bank on the mortgage to buy the building, or might owe some of the suppliers that ship the hamburger meat. Those are obligations of the company. That's the liability. You might see this in some of the reports we talk about as maybe an accounts payable, a notes payable. Anything that's payable to someone else is a liability. Owner's equity, on the other hand, represents the actual owner's claims on the business. It may be referred to as stockholders' equity if it's a corporation we're discussing. They own the stock, right? This amount will increase in two very important ways. Either the actual owner or owners will contribute to the company, say they provide cash or a resource such as a car, the assets will increase. Then the owner's equity would increase also, because we want both sides of that equation to balance. Or if the company is profitable for their business operations, then we would see the owner's equity increase because, and again, the cash might increase or the receivables might increase. We always want both sides of that equation to balance. Again, memorize it. Make sure you write this 100 times on your notebook, whatever it takes. It's very important. Okay, organizational forms. You might have heard of these before in your Intro to Business class, but there's three basic different forms: sole proprietorship, partnership, and corporation. Others do exist, like limited liability corporations, but we're not going to talk about those so much in this text. Sole proprietorships are a form of business that is owned and usually operated by one person. It's the easiest to create, and about 72% of U.S. businesses are run this way. You can see this just by driving down the street in our small town of Bowling Green. Lots of mom and pop businesses. They have one owner, and the ownership of that business is not separate from the actual owner's personal liability. What I mean by that is, if someone came into the business and fell down and broke their leg, they can come after the owner if the business is set up as a sole proprietorship, because there's no separation between the owner's life and the company. When profits are made on the company, those profits go into the owner's income tax return. There's no separation. Partnership. Partnership's a lot like a sole proprietorship, except for there's two or more owners. It's very similar. Again, the profits go into the owner's income tax return. There's no separation. It's still part of the owner's life. You're still held liable for the debts and actions of the business. We still use the term owner's equity when we talk about partnerships. Okay, corporation. We're going to talk mostly about corporations in this class. Corporations raise money through selling stock to different owners. That's how they have ownership of the business. We refer to owner's equity of corporations as stockholders' equity. So put that in your vocabulary. When we talk about owner's equity in terms of a corporation, we say stockholders' equity. Stockholders are the owners. We'll continue to use that term throughout the rest of the book. Corporations are entirely different than the other two. Corporations are a separate legal entity from the actual owners. It takes on the rights of almost a person itself. Corporation is liable for its debts and actions, not the individual owners, or the stockholders in this case. The disadvantage of owning a corporation is the cost to actually create one. And there's a thing called double taxation. So we had partnerships and we had the sole proprietorship. When there were profits of the business, that profit or that income was put onto the owner's income tax return. But now that we have corporations, the corporations are a separate legal entity and they pay a corporate income tax. Corporation's taxed, and then it pays dividends possibly to its stockholders. Those stockholders have to report that income from their dividends and they get taxed again. That's what we call double taxation. These public companies, you might have heard of public or private companies. Public companies are the ones that are selling their stock through public stock exchanges, like the New York Stock Exchange or NASDAQ. If you've ever heard of someone buying and selling something like Apple stock, that's a public company. They have the free will to be able to go out and purchase the stock of that company. On the other hand, private companies, like the grocery store Meijer's, does not have its stock open to the public. The stock is held by a small group of people, maybe like a family, and it might be offered to a select number of people, but you don't have the free will to go out and purchase that stock. Again, we're going to focus on corporations in this class. Okay, financial statements. This is the most important part of this entire class. Financial statements give us a health chart of the organization. Again, think of it like you go to the doctor's office. You get your blood test results back. This will tell you a lot of information about yourself, and it will tell a lot of information to the doctor, the external organization. The main core financial statements used by a business are the income statement, statement of retained earnings, balance sheet, and the statement of cash flows, and usually in that order. Each one of those statements is a health chart of a different side of business, but they all intertwine. Let's look at the income statement. The income statement can be thought of as the statement of operations. It's kind of a video of what happens over a period of time. In this case, I put a year, a calendar of a year, because we're looking at an entire period of time here. The main equation for the income statement is revenues minus expenses equals net income. Very basic. Don't let this confuse you. It's going to get more complicated when we add different types of revenue, different types of expenses. But generally, revenues minus expenses equals net income. And here's an example. This is the income statement for the month ended, so it's looking at just 1 month. Different types of revenues minus different types of expenses equals the net income. Next is a statement of retained earnings. Again, it's over a period of time. This statement used the net income we just got from the income statement and added that into the old balance of retained earnings, subtracted the dividends that were paid out to stockholders to get the ending balance of retained earnings. Again, here is the statement of retained earnings for the month. It's looking at 1 month. We saw the net income that we just got from the income statement added into retained earnings. Prior balance less dividends equals the current balance. Pretty simple. It reports the way that net income and the distribution of dividends affected the financial position of the company during the period. Next is the balance sheet. This is going to be a date in time. Draw a line in the sand. We're looking at one point in time. This is basically a recap of that basic accounting principle, the equation we talked about earlier. Assets equals liabilities plus stockholders' equity. We list the individual types of assets, liabilities, and stockholders' equity on the balance sheet and show the balances at that one point in time. Each individual account is going to be listed in order of its liquidity, and we'll talk about that later. But basically, that's how easy is it to convert to cash. Obviously, cash comes first. Then the money we want to receive from our customers, the receivables, and so forth. If it sounds like a lot to grasp in this first chapter, it is. Trust me. That's why we're going to look at each one of these individually in separate chapters. Here's an example for our balance sheet. We took the retained earnings we just calculated from the statement of returned earnings and put it into our balance sheet along with the assets and liabilities. Statement of cash flows, I think, is the most difficult one, but everybody loves money, so let's not make it too difficult. And again, this is something that happens over a period of time. Have you ever calculated how much you've earned at your job by day or by hour, even though you hadn't physically received a check or cash in the bank until maybe the end of the week or the month? Revenues work the same way. It's possible we sold a product to a customer and made a sale even though we haven't received the cash yet. So we're kind of backing into the cash that came and went and in organization. 3 main ways to get cash. It's either through operating, investing, or financing. Those 3 primary different operations, operating, investing, and financing, give us a change in cash for a period of time. We add that to the beginning cash balance to get the ending cash balance. Here's an example of that. Okay, so why do we have accounting rules? Accounting has been around for centuries. But at some point in time, our government realized we're not comparing apples to apples between our different companies and organizations. There has to be some sort of mainstream policy that all organizations and companies follow. Primarily, we're talking about public corporations, so that we can have information that's verifiable, comparable, and understandable when we look at each individual company. The main goal of financial accounting is to provide useful financial information to external users for decision making. We do that through what we call the generally accepted accounting principles. It's a flow down from our government, our U.S. government's Securities and Exchange Commission's rules on accounting.